Okay, so we are going to talk about estate planning and succession planning and kind of how things go and what happens after somebody dies and how you plan for transferring your assets, including if you have a business, to the next generation, and some of the issues that are involved in doing estate planning for both your personal assets and also if you do have a business, your business assets. So this first slide here, just some of the basic reasons that's important to do estate planning. That just so you know what these terms are, and we'll talk a little bit more about in detail of each of them. So first of all, one of the reasons you want to do estate planning is to avoid what is called intestate succession or intestate laws. And the word or the term intestate essentially means that you have not written a valid will while you're alive. Move that chair over there. And if you do not have a valid will, what happens is the law of whatever state you're in, or if you have assets in different states, it will depend upon what state the asset may be. So if you have real estate or other type of assets in one state or another, each state's a little different. As well as each country for that matter. So basically an intestate law is when you don't have a will and then the law of the state will dictate where your assets go in sort of a formula based upon what your family situation is at the time that you die. Are you married? Do you have children? If you don't have children, do you have living parents or brothers and sisters or nieces and nephews? And that sort of thing. And so essentially the way that this works is if you die, and here in Oregon at least, and if you're married and you have children, if all of those children are from that marriage, then everything will go to your spouse. But if you have children from a different relationship, then it gets a little bit complicated because only one half goes to your current spouse, and the other one half gets split among your children, including those children that may be from a previous relationship. Now that can lead to a lot of problems, as you can imagine, because especially if you have a situation where your current spouse does not get along with the children from a previous relationship, which is a really common thing. And that can lead to a huge amount of problems in terms of just inter-family squabbles, flat-out hatred about how assets are divided. You know, there's maybe a lot of resentment that the children have against the current spouse, and that can all be alleviated by making sure ahead of time that you have done proper planning in terms of having, first of all, a will, and then other estate planning mechanisms that we'll talk about, maybe a trust or beneficiary designations on your retirement accounts to make sure that you have put forward how you want your assets divided very clearly. Also, if it is a second or third or whatever marriage, it's also a good idea before you get married or even after you're married, you can still put together either a prenuptial agreement or a post-nuptial agreement, which is an agreement on how you're going to divide your assets in the event of a divorce or in the case of estate planning, in the event that you die. Like for example, I've got a couple right now. It's their third marriage each. They both have children from 2 previous marriages. Fortunately, they all get along very well, at least right now they do, but that can change. And so they have their own asset bases. Each of them came in with their own house. They have their own retirement accounts. They're retired. They have their own retirements that are paying out. They have their own Social Security. And so essentially they have set up their estate plan so that they've agreed together that when one of them dies, nothing's going to go to the spouse, but everything's going to go to their respective children. And they've done that ahead of time because they really don't want assets from the other one, and they each have enough where they can survive on their own, and they want their things to go to their individual children. And if you don't do that ahead of time, there's a presumption that part of it's going to go to your spouse, even if you didn't really agree on that, or even if that's what you want, but if you don't set things up correctly, that will still be the result, and that can lead to a lot of problems. The other problem with intestate law, if you don't have a will, then again, your assets are going to be distributed according to the law. And essentially what that does is if you're not married, if you have a spouse but you're divorced, or if your spouse died before you did, then under intestate law, your assets are basically going to go to your children, assuming you have children. And that can be fine. However, you may have a problem if, for example, you have a child that maybe has special needs, and that child, if they inherit any money directly, they may lose their eligibility for state public benefits because of their disability, and that can lead to ineligibility for a lot of different programs. And so it's important that, especially if you have a disabled child in that situation, like myself, I have a nephew who is on the spectrum for autism, and it will be important that we have a trust for him, which I'll talk more about later. But essentially, the idea is that we don't want assets to go to him directly. One, because he just doesn't really understand money. But two, that way he doesn't lose any eligibility for potential public benefit plans. So that's one component of it. Another issue with the intestate is if you have a child that you don't want to inherit anything for whatever reason, perhaps they have either a drug or a gambling or other type of problem, maybe they owe a lot of money and there's judgments against them, and if they inherit money, all that money is just going to be gone. And so you can do estate planning so that they maybe don't receive everything, instead it goes into a trust that one of the other siblings will be in control of. That's a real common situation. I have one of those right now where there's a child that has a severe drug and gambling problem. They're in and out of rehab. They're doing better, but essentially the parents set it up so that their sister would be in charge of their money essentially for the rest of their life. And then the sister has the discretion to be able to make decisions about how much money to give out, to pay perhaps rent or other utilities directly to the landlord or the utility company, so that way that money's not going to get blown on drugs or whatever. And you don't really have that ability to do after you're gone. So it's important from an intestate standpoint that you set it up that way. Another situation that is, I wouldn't say it's common, but it does occur, where an intestate that gives everything to your children could be a problem, is if you have a child that perhaps is in prison. I have several of those cases over the last about 5 years. One of them, the child actually is in prison for murder, for homicide on a life sentence. And so of course the parent doesn't want that child to get any money because it'll be gone. And so again, that money is going to be handled by their siblings, and they can distribute some of those funds as necessary. So it's really important. Also, if you don't have children, and you're not married, you want to figure out where you want your money to go. Essentially the way that the intestate law works is if you don't have any family, eventually, if you run out of family, in other words, you're not married, you don't have children, you don't have surviving parents, you don't have any siblings, you don't have any nieces or nephews, you don't have any great-grandparents, or grandparents or great-grandparents, essentially you don't have any family, all of your assets will end up going to the state. And you may not want that. And I've had a few of those cases where essentially we ended up, they donated all of their money to various charities after they died. But that has to be done before you, in a matter of estate planning, because intestate law, if you don't have a will, then the state would end up with all of that money. So that's one of the most important reasons to do estate planning and planning ahead of time, so that you don't run into this problem of having the state dictate where your assets will go, or to avoid some of those problems. And so we don't want to be what's called intestate when you die. The opposite of intestate, just so you know, is testate. So just the word testate. And that means that you died with a valid will in accordance with the law of the state where you live. And in that case, your will set forth where your assets go. And that will be subject to probate, which we'll get into in just a little bit. So that's one of the main reasons why you want to do some planning ahead of time, using various different mechanisms that we'll talk about, is to avoid that issue of having the state distribute your assets for you in perhaps a way that you really don't want. And there's really not really any way around that once you've passed away. The second big reason, this is probably in many ways even more important, this is one of the most important reasons why you want to do estate planning, is to avoid what's called probate. Now, probate in general refers to the court, a judge, and it is a division of a court that handles, essentially, after someone dies, the administration of their estate to make sure that if they have a will, that the terms of the will are being followed, to appoint whoever is named in the will as your personal representative. In some states that's called an executor, and to make sure that the taxes are paid and all the debts and expenses are paid, and going through that whole court process administered by a judge. Also, probate also refers to when somebody becomes incapacitated, or they're already incapacitated due to perhaps an issue from birth or whatever. Then the probate court also is in charge of appointing someone, which we call a guardian or a conservator, and that depends on what state you're in, that term. In Oregon, a guardian is somebody that is appointed by a court to have the legal power to make decisions for somebody about their health care, their placement, if they need to go into a nursing home or other type of facility, even if they don't want to go in, if they are determined to be incapacitated or they can no longer handle their own affairs due to whatever reason, either dementia or some other reason, then a judge can appoint somebody to be a guardian for them and be able to make those decisions. And a conservatorship in Oregon, or a conservator, is the name of the person that's appointed by a judge that has the legal authority to handle somebody's financial aspects. And so the probate court does things both while somebody's alive, in terms of incapacity and a guardianship, and also after someone dies, administering the estate. And the problem with probate is, well, several things. Number one, it is a court process, and there are a number of court rules that have to be followed in terms of the papers that have to be filed with the court. On the next page over, I've got a little outline of kind of how the probate process works. And it's a very extensive process. So you have to file a petition with the court. You have to pay the court filing fee, and that will depend on the value of the estate. The higher the value of the estate, the larger the fee. This is just to file the case. Several $100s, if not thousands of dollars, depending on how valuable the overall estate is. And then you have to go through a whole process of publishing a notice in the newspaper that somebody has died and that an estate is open, and the creditors therefore have the ability, if they're owed money, to file a claim with the court. And then there's a 4-month period for that to occur. And then if creditors file claims, if they're disputed, then the probate court will essentially hold a trial on how to handle whether those debts should be paid, whether or not they're valid debts to begin with. Probate court would also handle any disputes about the validity of a will, if there's a will, or if there's no will, about what law will apply in terms of intestate succession. If you don't have a will, then the court is going to require what's called a bond. A bond is an insurance policy that guarantees the performance of the personal representative, also known as the executor. So essentially, if they do not fulfill their duty to, in good faith, carry out the administration of the estate, that's an insurance policy that will pay. Maybe they absconded with the money, or they didn't invest it properly, or some other issue like that, then the bond would pay the damages that were incurred by the heirs of the estate due to the malfeasance of the personal representative. A bond is a good idea. The problem with a bond is they're expensive, because if you're even eligible to get one, if you have a criminal record or if you have a really bad credit, this is a form of an insurance policy, and credit reports will be run, and the insurance company may not be willing to issue a bond if somebody is not creditworthy or they have other legal problems of their own. Also, if they have, in Oregon, if they have a felony conviction, they may not be eligible. And so one of the other reasons why you want to make sure you have a will is you can waive the requirement for a bond to be filed. And that, the last bond I had to do, I was on about a $500,000 estate, and I want to say it was about $1,000. So it adds a lot of expense. And usually you don't need that because, everything's in the family and it's not a big deal. There's a 4-month period in the probate process for creditors to file claims. That's a minimum period that the estate must remain open. That's also why we want to try to avoid probate, not just because of the cost to file with the court, the cost to pay the newspaper for the publication, which can run close to $1,000 depending on where you're at. Here in Polk County, it's a lot cheaper because we have the itemizer. But like the Statesman Journal, they're about $700 just to print that notice. You've probably seen those in the legal section of the newspaper. It's got the little blurb, somebody died, if you want to file a claim. So again, we have all those costs that are involved, and then there's a minimum 4-month period. I will tell you right now that probate usually takes, at a very minimum, about 7 months. Because there's 4 months that it has to stay open, and then there's about a month or 2 on either end, plus you have to get tax returns filed, and then you have to sometimes wait for all the end of the year statements to come out. So usually a probate's going to run about a year or even more. I've had some probate cases that have gone on for more than 5 years, just because they were very complex. So there are ways to avoid probate that we'll get to in a moment, that if you're able to do that, it's going to save a lot of time and a lot of money and a lot of adversarial components. If you have out-of-state property, I already talked about filing fees, so out-of-state property, that's another reason why you want to avoid probate, because then perhaps you have a house, like I've got a client right now, they have property in Oregon and in Oklahoma, and if they die, then we're going to have to open a probate in both of those states. And so now you've got double the expense. And so if you can avoid probate through these various mechanisms that we'll get to, that will save time and money and the possibility of having to file in multiple different states, which can be really expensive and time consuming. You got to get multiple lawyers involved, and that's always expensive. Again, it will depend on whether or not you have a will or no will, on how the assets are ultimately divided. And then finally, one of the points about the probate process is that it is a public record. And the reason why that can be important is, number one, an inventory must be filed with the court, and that inventory will list all of the assets that are subject to administration by the court in the probate process. And that's now public record, so everybody in the world can look that up and know what you're inheriting. And that can also lead to problems if, for identity theft issues, or creditor issues, or other family issues. They may learn about things that are intended to remain private, but now because they're public record, it all kind of comes out during the probate process. So at the end of the day, what I'm leading up to is the ability to avoid probate and having to go to court is one of the most important, in some cases the most important purposes and reasons why you want to do estate planning, both from a cost standpoint and the time that it takes to get through that whole process. Okay, so the next major reason to do estate planning is having to do with estate taxes. So estate taxes are taxes that are levied on the value of the assets that are transferred after somebody dies. And this is a constantly changing area of law. This depends on both federal law and state law, because there's estate tax at the federal level, and there's also state tax depending upon what state you're in. Some states don't have an estate tax, some states do, and the levels that they kick in are different from one state to the next. So currently, the federal exemption, the way that this works, is you'll have an exemption that will allow you to transfer to your heirs an amount of dollar value of assets that are tax-free. But any assets that are above that value will be subject to the tax. And that tax can go as high, if I remember, 48% is the highest for federal. So that could be basically half of the money is gone in taxes. Now that doesn't kick in until many, many millions of dollars. As you can see here, the federal limit right now is 12,160,000 or something like that. It changes all the time. It's indexed. But it's around 12 million. So that's a pretty large amount of money that you can transfer federally tax-free. State of Oregon, however, has a much lower level, which is 1 million. And so you may not be, and most people are not going to die having $12 million, but $1 million nowadays is pretty common for people. By the time you add up the value of your house, your retirement account, if you have any savings, life insurance also comes into play. It's pretty common to have a life insurance policy that may be $1 million. The life insurance itself is not taxed, but it adds to your overall value of your estate, and so that could push your estate over $1 million when you add up the life insurance and the house in your retirement pretty quickly. And so in Oregon, each person can shelter $1 million. That means if you're married, each spouse can shelter $1 million, but in order to do that properly, you have to have in place proper documents to allow that to occur. Otherwise, when one spouse dies, all of the assets go to the surviving spouse, and then when they die, it's all taxed. So you lose the $1 million exemption. Now, one way to plan for this, if you do have what's going to be what's called a taxable estate, that is either federal or state or both, by setting up what's called a bypass trust, sometimes known as an A-B trust, alternatively known as a credit shelter trust. Now we'll get into a little bit more about what a trust is in a little while. But essentially what this does, this will, I'll just do a little diagram here. Let's say you have two spouses, spouse one and spouse number two. Each of them can shelter $1 million. So let's say they have $3 million of assets. So when they die, the way that you would use a trust in this respect is you would set up a trust before they die together, or perhaps they each have their own, but most of the time we'll have one trust while they're alive. And then let's say this spouse dies first, we will put $1 million or perhaps more into their trust, and that will be separate from the remaining $2 million that will go with the survivor. And so we'll have two different trusts. This trust is called the bypass or credit shelter, is what I like to call it. And that will preserve this person who died, their $1 million. And essentially what will happen is that $1 million will be held in trust until this other spouse dies, and at that point it will go to the children. The surviving spouse over here will also have a trust for the remaining amount. So we basically are dividing everything into two, 1 million or whatever the exempt amount is for the person that died first, and everything else to the survivor. And then they can live on that while they're alive, and then eventually when they pass away, it will go to the kids. Now this is a very common method for estate planning when you have a taxable estate. It's called a credit shelter trust, or an A-B trust. This would be trust A, and that would be trust B. Or a bypass trust, meaning you're bypassing the deceased person. So it gets a little bit complicated there. Question, go ahead.
Yeah, so say spouse one dies.
Right.
That million goes like straight to the kids.
Okay, so the way
Say
this
they're not
works.
really old enough to like manage their.
Okay, that's a great question. So the question is, there's kind of two parts to that question. Number one is, does it go straight to the kids? Let me answer that one first. No. The surviving spouse, if they need to access that money, because they don't have enough of their own, perhaps, maybe they have medical issues, they have to go to a nursing home, or whatever, right? You know, they need to access that money. They can access that. There are some restrictions on how they do that, but it is available to the surviving spouse while they're alive. And then whatever's left over would then go to the children. Now, to answer your second question, if you have children that are underage, or even if they're over 18, but perhaps you're not comfortable with them receiving the money until they're maybe 21 or 25, or even 30, or even older, then you can put a provision in that trust that will require that the money be held until they reach a certain age. And then during that time that it's continued, whoever's the trustee, and that's usually the surviving spouse, or it could be a professional like a bank, they have trust departments like US Bank or Pioneer Bank, Trust Bank in Salem. They have trust departments that do that, and they'll administer and hold that money, and they can use it to pay for the children, for their education, their health, their welfare, their housing, you know, just like a parent could during that time period. And then eventually when they hit a certain age, that money would be distributed down to them. And that's true of all trusts.
And do the kids necessarily know about this?
That's another great question. So the question is, do the children necessarily know about it? Short answer is maybe. And it depends on how the trust is set up. It is possible to set up a blind trust, but most of the time, and most law requires that the beneficiaries of a trust be told about the trust, and also what assets are in the trust, and they can ask for an accounting every year, and that just kind of depends on the trust. But there are ways to set it up so it's sort of a silent trust until the time comes. And also, they may be contingent upon other things. So in other words, it would say that these children will inherit so long as, like I had one client that said they only inherit if they got a college degree. If they didn't get a college degree, their money went to charity.
Really?
Yeah, it's pretty. They all got college degrees, so.
Yeah, go to college.
And I've had other clients that have set up trusts, kind of on that similar line, that said, okay, you don't get your money until you're age 30. However, if you get a bachelor's degree, you get half of that as soon as you get your bachelor's degree. If you get an advanced degree, a master's or a doctorate, you'll get the other half when you get the advanced degree. And that was the way that they would encourage that. And you can set that up however you want. Another option is you can pay that money out in stages. So it's pretty common to say, all right, in my trust, the first 1/3 of a child's distribution will be when they're age 21. And then they'll get another 1/3 at age 25, and then the final 1/3 when they're age 30.
Oh wait, they just don't blow through it all.
Yeah, exactly, so they don't just blow through it all.
And then, so say it's blind, how do the kids find out? Because obviously it's about.
Well, eventually, depending on how the trust is written, the trustee, whoever is in charge of the trust, and that might be a spouse, or it could be a sibling. Like I have it set up in my own estate plan, if my wife should die before I do, my brother can take over for any minor children. Now, my kids are all grown now, but when they were little, that's how I had it set up. So my brother would have been in charge of that, and then he would have the legal duty to notify the children of the trust, depending on the terms of the trust. So, and you know, trusts are really, really flexible. You can set them up in many different ways. We'll get more into trust here in a few minutes, but good questions. So please, if you do have questions, let
And
me
it
know.
doesn't have to just be kids, like it could be grandkids, it could be nieces, it could be nephews. That
Anybody you want.
Yeah.
Yeah, you can give money to whoever you want through a trust or through your will. That's another good question. You don't have to give your assets to your family. You can do that through a will or a trust or a combination of the two, and you can give it to whoever you want. There's nothing that says you have to give anything to your family. With one exception, if you are married, there are some laws that require you to give, like in Oregon, 25% minimum to your spouse. And then also under some retirement plans, your spouse, depending on the type of retirement plan, may have an automatic right to the retirement plan. But other than that,
What about like divorces?
okay, so in a divorce,
Sorry.
yeah, no, this is also where trusts are used all the time. Because a trust can specifically say in the trust that the money that's going to my child is intended to only be my child's money and not their spouse's money. And if they do get divorced, then it says in the trust agreement that that's intended to remain separate property and not subject to division in the divorce case. And that's a pretty common paragraph that we put into a trust, especially in family business, because you don't want the family business ownership to end up going to an ex-spouse. And so the best way to do that is, number one, have them have a prenuptial agreement that also says that, and then have that trust that says money that does go to them is not intended to go to their spouse. Now, with that said, a judge still has the ability in a divorce case, even if you put that in your trust, the judge has the power to, I'm not sure disregard's the right word, but to take that into account when making what's called an equitable distribution during a divorce case. And usually the way that that's done is in terms of, you know, if you have somebody that's receiving a lot of money in the trust as an inheritance, the ex-spouse may not directly be able to get that money, but that money that they receive can be used to determine how much spousal support might have to be paid, or the judge might end up giving the other spouse that's not part of the trust more of their joint assets, like perhaps their home or their other commingled joint assets. So it's not an absolute firewall to prevent that, but that is really common. I have that paragraph that probably goes into at least half of the trusts that I write. It says that the share that goes to the child is not intended to go to the spouse. While we're on that point, great question. The other way that whole thing sort of crumbles is, let's say my trust says that my child is going to receive, let's say 1/3. I have 3 kids, so. And it's intended that 1/3 is only for that child and not their spouse. So let's say my child then receives it from the trust. And now they put it into a bank account, or they buy a house and they add their spouse's name to it as a joint asset. That just completely destroyed that whole thing.
Yeah.
Because as soon as they commingle that,
They used it, but now their spouse's name.
as soon as they got it, they added their spouse as an owner on it, and then all of that language that I put in there basically goes away. Now, the other advantage of a trust, or another way that you could use a trust if that is an issue, is you could provide that the assets itself will be held in trust forever and never distributed to the child other than the income. So the income, maybe it's like a forest or a farm or a business, or it even could be a stock portfolio. that's held in the trust forever. And the only thing that's distributed to the child is the income each year. But all of the land and everything else stays in trust essentially forever. Well, not forever, but for the lifetime of that child. There are rules on how long a trust can go. It gets kind of technical, but you can't have a forever trust. But there are ways to use trust to carry that out. Another option too is, even if you don't want to keep the trust going forever, you can put a provision in the trust that says that instead of keeping the trust going forever, you'll take the money that that child is to receive and perhaps you'll buy what's called an annuity. An annuity is an insurance contract that will pay out X amount of dollars either per month or per quarter or per year for the life of that child. And that's done directly by an insurance company. And that's also a good way to protect those assets, because once it goes into that annuity, it's pretty much set. Downside is they're expensive. While we're on that topic too, another reason why you don't want to keep a trust going forever is because a trust has to file its own tax return. That kind of a trust. And the problem with that is, number one, you got to pay the accountant to do a whole new tax return for the trust and for the other person. So like in this case where we divide it in two, this trust for the deceased spouse, that's going to require a separate tax return from the surviving spouse, who will also do their own tax return. So that adds expense. The other problem with keeping a trust going on forever or a long period of time is the trust is subject to a higher, it's called marginal tax rate, than an individual. So the more the trust makes, it bumps up into higher tax brackets quicker than an individual person does. And so you basically have to end up paying more tax than you would if the money was just distributed straight away. I know I'm kind of getting off in the weeds here, but these are great questions. So, all right, we'll come back to trusts in a bit. I'll kind of explain how they work in a little bit more detail in just a moment. So let me see here, where was I? All right, so one of the ways that you can plan for estate taxes is doing this bypass trust, credit shelter trust. Another issue is what we have is called Oregon marital property. This is what we were just talking about, that property that's acquired during a marriage is presumed to be joint with both spouses. And also we have the ability to transfer between spouses an unlimited amount of money during their lifetime and up to a certain amount of time after they've died without that being taxable. And so that allows for some planning. It gets more detailed than that's more of a tax law thing, but that is something that we just talked about. And then finally down here, I also want you to be aware, this is especially true for family business and natural resource industries, farm and forestry, fisheries, but primarily farm and forest businesses. And so one of the problems with Oregon having $1 million tax level is when you have a family farm or a family forest or other type of natural resource business, where essentially, I like to say, you're dirt rich but cash poor. And I've got this case going right now exactly. We have a family who's had a farm, well, they're well over 100 years. It's a century farm. And so they're going on to the 4th generation now. And the farm is worth probably $8 million or so of ground, hundreds and hundreds of acres. They don't have a lot of cash, but they've got a lot of land that's very, very valuable. And so, this $1 million for farmland, now when they die, they're married, so they can shelter $2 million. That leaves $6 million that is going to be subject to tax in Oregon. Oregon estate tax starts at 10%, and then it goes up, if I remember correctly, to 16% as you go up in value. And so let's just leave it at 10%. So now if they have $6 million of value in the dirt, that's taxable, that's $600,000 of cash that they're gonna have to come up with to pay that tax. So how do they get that cash? Well, take out a mortgage, you know, they may not have the income to support the mortgage. Other option, you gotta sell the farm, or a part of the farm. And so this has a potentially destructive effect on family farms, family forest industry, but not just family, you know, it could be a restaurant chain or any kind of business where you've got this tax on all of these assets, but you don't have a lot of cash. Now there are ways to plan for that. One way, again, is a trust, where you maybe buy life insurance in the trust, and there's a way to set that up so the life insurance is owned actually by your children, not by you when you die, so it's not in your $1 million. But you gift them money every year to buy the life insurance policy. I might have a slide on that. It's way above. Hold on, I can't remember now. I don't. At any rate, so essentially using life insurance to pre-fund and pay for that while you're alive, and then when you die, there's money from the life insurance policy available to pay that tax. That way they don't have to sell the farm. Now the problem with that, of course, is depending on a person's health, that life insurance policy may be really expensive, if they're even insurable. You know, if they have major health issues and they're older, they may not even be able to get life insurance. So that gets to be pretty technical. It's called an irrevocable life insurance trust, or an ILIT. Again, kind of beyond the scope of this class, but it is another method to use to help pay for those estate taxes. Now in Oregon, we do have, and this is true for most states, they have an estate tax. We do have an exemption for family farms and other type of natural resource industries, where so long as after the person dies, their family continues to farm the property in an active role for 5 years, then a lot of that tax is removed. It's not 100% of the estate tax, but it is a large percentage that becomes exempt. So essentially this $1 million, if the majority of the value of someone's estate when they die is the value of the farm or the forest or other land, then, and so long as they continue to do so for 5 years after death, then essentially that part of their estate is not subject to the estate tax. Now it's not quite that simple, because there's a formula to it, which I don't want to go into here, but the problem with that in Oregon is the family has to actively farm. They can't lease the property out, and that's pretty common. You know, if you have farm ground or other type of property, you get older, if you're a farmer, you don't want to farm anymore, so you lease it out. You get your annual rent payment, and you don't have to do the work. And hopefully that provides enough cash. The problem is that's not going to necessarily reach the level of being active involvement for that tax credit. So yeah, that can lead to some problems. That's why it's really important, if you're, again, dirt rich and cash poor, to make sure that you think it through ahead of time how to go about reducing those estate taxes. Okay. So let's now move over to this next slide and talk about the standard documents, sort of basic documents for estate planning that we commonly do. And this, again, will depend upon what assets you have, if you're taxable or not. And, you know, there's a lot of variables involved. But number one, of course, is to have a will. And the will specify who you want to have in charge after you die as your personal representative. It's always a good idea to have at least one, if not more, alternative people named. in case the first person you name dies before you do, or they become incapacitated, or they flat out don't want to do it, which is pretty common. Then it goes to the next person in line, and I like to have 3 people at least, so that way you've got one and another and another. And then of course the will, and this will depend if you have a trust or not, because if you don't have a trust, the will distribute the assets directly from the will. If you have a trust, what a will do is put the assets into the trust post-death. So it's very important, again, to have a will. The other reason why, a part that I forgot to talk about in the will, is if you do have minor children, you want to make sure in the will that you name a guardian with alternatives. So if you and the other parent happen to die or become incapacitated, you set forth in the will who you would want to take care of your kids. So maybe it's a sibling or a parent or a grandparent. That way the judge knows who you choose to be the guardian for your minor children. That's also where we would include language like we just talked about in your will, where if you have a minor child, or even if you had a child that was an adult, you have that trust that would be set up until they're a certain age. Or if they're incapacitated, that trust might go on for the rest of their life. All right, the next form that is very common, I'm not sure if I think it should be mandatory, is what's called a power of attorney form. So power of attorney is when you are naming a person to be able to engage in financial transactions on your behalf, to sign your name, to access your bank records, to pay your taxes. If your house needs to get sold so you can go into a nursing home or something, they can sell your house or other type of assets that you have. They can do stock trades and mutual funds and engage in your retirement account. And so a power of attorney form, the idea is that if you become sick, or even if you're not sick, if you're on vacation or something, then somebody has been named with alternatives. I like to have 2 alternatives at least, to be able to handle things for you. Now, there are different kinds of powers of attorney. There are powers of attorney that are called a general power of attorney, and that's intended to essentially allow someone to do anything, with some exceptions, that the other person could do financially on their behalf. The only thing you can't do, you can't vote, and you also cannot write a will for someone. Only the person can do that themselves. But they could access tax returns and all that kind of thing. There's also what's called a special power of attorney, and that is a power of attorney that is related to a very specific power that you're giving someone. So for example, I had this here a few years back. I had a client who was a real estate developer, and they were selling lots in a subdivision. They had like 100 lots in this big subdivision, and this person was going on vacation. And so they were going to be gone for like a month. And so they gave a special power of attorney to their business manager to allow that manager to be able to sell lots if they were gone. That way they didn't have to track them down. I think they were going to Europe. Track them down in Europe to be able to sign real estate papers. So it was a limited power of attorney for a 6-month period. We wanted to give them extra time on each end, and that allowed the business manager to be able to sell the real estate and sign all the paperwork on behalf of that person. And so essentially a power of attorney is whenever you're giving someone the authority to sign your name for you for financial purposes. Now, a couple things I want you to know about a power of attorney. First of all, there are 2 kinds of power of attorney. One is in effect the moment you sign it, like right now. Even though you're still mentally competent, you can do it on your own. The other doesn't go into effect until and unless you become incapacitated. Maybe you have developed Alzheimer's or whatever. That's called a springing power of attorney. Now the problem with the second kind of power of attorney that doesn't go into effect until you're mentally incompetent is the determination has to be made by somebody that you no longer have mental capacity. And that's usually going to be a doctor, but the problem there is you got to get a hold of the doctor and have them do a letter saying that this person is incapacitated. And that may not be very easy to do. Also, banks don't like those kind of power of attorney forms because then they're relying upon the representation from this doctor, and they don't really have any way to cross-check that. And so oftentimes they will not accept that form of a power of attorney. And that's why we typically don't use those kinds of power of attorney forms. The power of attorney form that I will typically use in my law practice is called a general durable power of attorney. And that is a power of attorney that goes into effect the day you sign it, even though you're still competent, and it will stay in effect even if you become incompetent. So I have, for example, in mine, I name my wife as my primary power of attorney, and then I have my children as alternates. And that way, if something happens to me, she can, sign papers and all that for me. And then on down the line, if she were to pass away, then next in line is my next oldest.
So she can sign papers for you right now?
Right now, yeah. Which brings on the next issue with the power of attorney. You gotta make sure the person you appoint is somebody you trust,
Yeah.
right? Because they could, and unfortunately this does happen, it's real world, not real common, but it does happen, where somebody will misuse that power of attorney for nefarious purposes. They may just go bleed all the accounts dry and go over to Grand Ron Casino and, blow it all. That's illegal, that's theft, it's a crime, but once the money's gone, that could be a problem. It's also potentially elder abuse, so.
So that's considered a crime even though you, trusted them with the money?
The power of attorney, when you're acting on behalf of the person, has to be for their
Best.
interest.
And that, obviously gambling is not in their best interest.
Yeah, right, or they take the money and they go blow it on a vacation to Tahiti or something, for their own use. It has nothing to do with the person.
Yeah.
Now, sometimes you get into gray areas. Like, I had a case once where they used the power of attorney to take the person on a trip to Hawaii. They went with them. Now, the person who they had the power of attorney loved it. They had a great time. Blew a lot of money, but, the other children were like, why'd you do that for,
When we get it.
Yeah, so there, that's kind of a gray area. Ultimately that'd be up to a judge,
Yeah.
but that's one of the problems with the power of attorney is, you gotta trust the person, and then,
Was that person that they took incompetent or competent?
they were
Borderline.
they had dementia,
Yeah,
they
yeah.
still were somewhat functional, they knew where they were at
Yeah.
and all that. Now, if you ask that person, where do you bank? No idea.
Yeah.
But, they knew what
They
Hawaii
had a
was.
good time.
They had a great time,
Yeah,
and,
yeah.
they went to Hawaii and had a good time, and they had grandkids go with them, and,
Yeah.
and so, that gets to be a gray area.
Yeah.
This is also where a trust is useful, because a trust can allow, if you become incompetent, whoever you name as your alternative trustee will take over. It's kind of like a power of attorney, but only for the trust assets. So that's another really good reason to have a trust.
So say, someone's wife is the power of attorney, signed it, everything. Say they have a falling out just out of nowhere. How do they change that?
Okay, so a power of attorney is revocable
Okay.
by the person,
If competent.
yes, and if they're incompetent, a judge can revoke it
Okay.
as part of that guardianship process. Problem though, as you pointed out, and I have seen that happen as well, I've seen a spouse go drain the bank account and then take off. a judge will take that into account during the divorce, but again, if the money's gone, you can't squeeze blood out of a turnip thing. Once it's gone, and there may not be a way to get it back. So yeah, that can't, there are pros and cons to it. For the most part, it is beneficial to have. The other thing about a power of attorney, well, two things. Number one, they become stale. Depending on where you're at, some states have maximum time limits that they're valuable, that you have to renew them. Typically, it's about 7 years. Also, the other thing on a power of attorney form is I am seeing this, really in the last 5-6 years, where financial institutions are no longer accepting power of attorney forms that are not their own internal form. So for example, if I have a brokerage account, let's say with Charles Schwab or some other brokerage company where I have my retirement and other stuff, they may have their own internal form that they will only recognize. They won't recognize a form even prepared by a lawyer because they get burned. And they've had to, if they've recognized a power of attorney, it turns out it was revoked or not valid, then they can be sued perhaps to recover the money that was used incorrectly. So that's something very important. Even with it's a good idea to have that power of attorney just in general, a general power of attorney, but also you need to check with your specific financial institution to make sure that they also don't have their own internal form. If you want to revoke a power of attorney, it has to be done in writing and it has to be notarized, and then oftentimes you'll record that with the county. That becomes part of the public record, so there's a record of it. There's not really a general registry of wills or power of attorneys. They've talked about doing that, but it would just be very cumbersome to set up. So that could be another problem, is you may have revoked it, but the bank or other people that know about it haven't received that information yet. So on balance, power of attorney is really a necessary form, I think, but there can be issues. And again, you can also limit in the power of attorney what powers or limits you want to put. I don't normally like doing that just because you never know what's going to happen. And if you only give somebody a certain power, you don't give them another power that you normally would, who knows that might occur. They might need to do that for you. Anyway, all right, the next form is called an advance directive. Some states call this a living will, and this is a healthcare form. So this is like a power of attorney. Some states call this a healthcare power of attorney. And this is a form that you fill out while you're still competent, where you name a person to be your healthcare representative with alternatives, and that will give them the authority to talk to your medical professionals, your doctors, whatever. You can also delegate to them the authority to make end-of-life decisions such as tube feeding, life support, spoon feeding, whether or not you want to have pain medication and all those things. And you can also make the decisions ahead of time about whether or not you, if you're in a certain scenario, like perhaps if I'm in a coma, and it's determined that I will not likely ever come out of the coma. Obviously we don't know for sure, but for the most part they're going to be able to say at this point, vegetative state, we can keep them alive on life support, but never going to come out of it as far as our opinion. That's what the doctors would say. And at that point you can make a decision ahead of time that you don't want life support, you don't want tube feeding, you don't want to be kept alive if you're in a permanent coma. Same thing, if you have an advanced progressive illness like Alzheimer's or cancer or some other physical ailment such as that's debilitating and is permanent, you can decide ahead of time, you don't want to be tube fed. Once you get to the point where you can't swallow, you don't know what's going on, you don't want to be tube fed, it just basically keeps you alive. You don't want life support in those kind of situations. So this is a standardized form in Oregon. And again, most states have their own form. This is usually available from your doctor or your insurance company or the hospital or the nursing home. Again, it's a standardized form. They do change it every so often. And also it's important to know that if you move to a different state from the state where you did your will, power of attorney, and advance directive, you really want to double check to make sure that the state law is the same in how the requirements for those forms are set up, because states have different laws when it comes to how you do a will, what form it has to take, power of attorney forms, healthcare directives. And so if I do a healthcare directive here in Oregon, it may not be valid, say, in Mississippi. So if I move to Mississippi, you're going to want to double check that that form probably needs to be redone, because otherwise doctors, they have some liability if they follow a form that's not valid. All right, the next document is called a transfer on death deed. Transfer on death deed. Sometimes these are called beneficiary deeds. So this is fairly new in Oregon. Other states have had this for quite some time. But this allows you, for real estate, your house or other real estate that you own, to be able to list on the deed, that's the ownership record, who will inherit that property after you die. And so, for example, I may put on my house, after I die, the property is to transfer upon my death to my children equally, or the survivors of them if any of them should die before I die. Now this is a big advantage, because this allows you to transfer that real estate without having to go through the probate process, the court process. And again, it's fairly new in Oregon. The other way that you can transfer real estate without going through court is with a trust, which again we'll get to more in a minute. So these are becoming really popular. However, there's some limitations on a transfer on death deed. And first of all, the first limitation is you don't really have the ability to have contingencies if your child dies and you want their share to go on to their kids, your grandchildren. You don't really have that ability in this kind of a deed. It's only for real simple transfers. Also, if you want to give, 10% here and 5% there and 15% there, and you have a number of different percentages, it doesn't really work for that. They're intended to be really a shortcut, real simple, transfers to your children equally or whatever. But this is a pretty popular method. If you have a more complex distribution pattern, or you want to make sure you have contingency plans if one of your children dies, you want it to go to their kids, you're really going to need to do a trust, because you can do all of those kind of contingency plans in a trust. All right, next we have, this is spelled wrong, but beneficiary designation, POD, TOD. So these are one of the most overlooked areas of estate planning. This is also an area where I find problems that can occur with your financial advisor or banks that don't really understand how these work. So let me just explain what we mean. A beneficiary designation, POD stands for pay on death. Actually, I have this on the next slide right here. So POD, pay on death, TOD, transfer on death, and then beneficiary. All right? So these are all kind of the same thing, more or less the same. What these are is, like I was just talking about with the deed, these are forms that you will fill out with a financial institution, a life insurance company, an annuity company, your retirement account, your 401k, your IRA, your 403b, whatever kind of retirement plan that you might have, that will tell the financial institution who will get the money after you die. And this does have the ability, depending on how complex your distribution plan is, you do have a little bit more flexibility with these. But essentially, this is the idea that, for example, a payable on death, if I have a checking account, during my lifetime, perhaps I want to have one of my children on the account with signing authority so they can sign checks for me, very common. But upon my death, I want that account to be split equally to my 3 kids. So I will fill out a payable on death form at the bank to name my 3 children. That way when I die, that bank account will transfer over to them. And that's outside. It does not have to go through the court process. So this is a way to avoid probate that's basically free. It's a form you fill out at the bank. TOD, transfer on death, again, like I just talked about, is the term we use for deeds and potentially other type of assets and financial accounts, depending on what state you're in. That's basically the same thing. That's where you fill out a form or a deed where you name who you want that account or that asset to transfer to after you die. A beneficiary designation is for retirement account, life insurance, annuity, and other similar types of financial assets. And that is where you designate a primary, and I like to have people designate contingent beneficiaries, so that when you die, for example, on life insurance, I have my wife named as my primary, then I have my 3 kids named as my alternates in case she dies before I do. And that way the money will transfer to them without having to go through court, without having to go through the whole probate process, directly to either my wife or my kids, depending on the situation. Now the reason why I'm pointing these out, these are overlooked even by lawyers, because you think you've got your will and it says what you want. The problem with the will is it has to go through court. You should always have a will no matter what, but you want to try to avoid having to use the will. I know that sounds kind of weird, but the will is like a backstop in baseball or softball. It's intended to catch things that you didn't plan for otherwise. And so hopefully you won't ever have to have the will utilized, because then that requires a probate. So that's why you want to fill these forms out ahead of time. You also want to make sure, a couple things. Number one, that you print these forms out and put them in with your estate planning. I like to have people have a binder or a file where you have your will and all of your estate planning documents. Perhaps digitize them, which I like to do. Keep them so you've got them in a digital format as well. And then make sure you've got copies of these forms in your estate planning packet, because number one, I have seen situations where a life insurance company got bought out by another company, and then they got bought out by another company. The policy changed from one company to the next, but somewhere along the line, the beneficiary designation that was filled out, say in 1972, got lost. And then you have to go to court. So it's also a good idea to double check these from time to time. If you're working for a company or if you have a government position, you'll have what's called open enrollment, and that usually occurs in October every year. And that's where you'll fill these forms out and you can update them. And again, it's just a good idea to have those printed out, keep with your important papers. Also, that way your heirs know that they're there. They otherwise may not know. Now here's another little issue with all of these 3 kinds of forms. These forms are specific to that account. And the account or the life insurance policy or the retirement plan will transfer pursuant to those forms, even if your will says something different. And so this is a pretty common situation where somebody may fill the form out years ago, and perhaps they named somebody, a friend or a brother or a sister or somebody, and then they get married, they have children, they no longer want that money to go to that person, but they forgot to update that form. And so, of course, they die, their will says everything goes to their kids, but they've got a beneficiary form saying it goes to their niece or something. That can be a problem because the will only applies to assets that don't transfer through some other mechanism, such as this. So it's very important when you're doing your estate planning that you take into account those forms to make sure everything works together. Also, with that said, these can be used as a way to transfer an account outside of your otherwise normal distribution plan. Let me explain that more of a real world scenario. Let's say that I want a certain amount of my money to go to a charity after I die. Everything else I want to go to my children equally. So I might set up a special account that I'll use during my lifetime. Maybe it's a brokerage account where I have stocks and bonds and mutual funds. But I want that one particular account perhaps to go to the university to start a scholarship in my name. So I might set that account up and I'll fill out a pay on death designation